Hello, everyone. We'll give everyone a couple minutes to get loaded into the session. So Kevin was telling us backstage he has a 3-week-old. So are you getting any sleep?
Barely, but you have me at my best.
And you have three. What are their ages?
Yeah, so one will be 6 here in a couple weeks, the other's 3, and then newborn.
Oh, geez.
Yeah,
Yeah, I
it's
have a hard
busy
time
time.
handling six four-legged children. I can't imagine three two-legged.
Yeah, we have 4 of the 4-legged variety too. So they
Oh
very full
boy.
house.
Ryan knows what that age spread looks like too. All right, Kevin, you're frozen for me. I want to know if it's my bandwidth or yours.
Think it's yours, Jody, because you're frozen.
Great.
Yeah, I can hear.
Kevin, she may need to come out and go back in. Looks like she's, yep, there we go.
Okay.
All right, I'm back. Can you hear me?
I can hear you.
Yes.
All right, hopefully this holds out. If not, Kevin, you know what the topics are. Ask yourself the questions and keep rolling. But
I'm the voice of
Okay.
God. Bernard says from the heavens above, the voice of Amy Poehler.
that is awesome. So, welcome back to the latest in mortgage today, the show where we skip the rate and LO chatter and get into what leaders and executives are actually dealing with on a day to day. I'm Jody Hall, the CEO and president of the Mortgage Collaborative, and it has been a pretty eventful, well, I was going to say couple of weeks, but I just feel like I was talking to a lender yesterday, and we are now in our fifth year of a pretty crappy market. So we'll say eventful being uneventful a couple of weeks in the industry. So we've got a lot to go over. So joining me today is Kevin Strika, the VP of Operations at First Option Mortgage. Kevin's been with First Option since 2013 and holds an MBA and the AMP designation. And I hear that something else is going to be in the works soon and doubles as the company's Encompass LOS administrator. So he's got a front row seat to both the process side and the tech side of running an independent mortgage bank across 39 states. And we're going to start with what's going on in Kevin's world at First Option right now, and then we'll get into e-notes and rates being stuck and affordability that actually we have a positive spin on, and then also just a blurb on CFPB regulations and the Two Harbors acquisition by Cross Country Mortgage. So, Kevin, welcome to the show.
All right. Thank you. Thank you for having me.
Yeah, absolutely. So, as Kevin is the VP of Operations at First Option, walk us through what your role covers or looks like on a day to day. You can skip the part of up at 3 a.m. with 3-year-old and just start with what your workday looks like.
Right, right. Yeah, that part's a given. So the way I always explain it is I'm responsible for the process and technology from POS all the way through post-closing. And I work with 2 other key individuals to help bridge some of the gaps that I don't cover. So we have a VP of credit risk that's hyper-focused on underwriting and a VP of secondary that's hyper-focused on those capital markets. But anything in that spectrum other than those 2 specialties really falls to me. So just setting up the technology and the process to take a loan all the way from from borrower application through, disclosures, processing, closing, post-closing, compliance, pretty much anything that's not, in one of those two buckets where I have a partner, is all rolls up to me. So, I get to make a lot of those key decisions on, what loans go where, what actions get fired. And I get to use a lot of that experience to, design a better mousetrap, each and every day. And paired with the Encompass experience, I pretty much have the knowledge to do that and the tools with which to do it as well. So that helps me iterate very, very quickly to make our process better and better.
Yep. And that's you. So for the listeners who don't know First Option, give us a quick picture of the independent mortgage bank in 39 states, over 2 decades of business. What's it like?
Yeah, so like you mentioned, we were founded in 2003. We still have one of the original managing partners here every day. We've got about 100 loan officers and, a great operations team, right? So we have a mix of branch-based and corporate-based operations people, but it's very small, very tight-knit group. Everybody knows everybody. There's no stranger, in the entire structure. We tend to be, as a ops organization, pretty small and intimate. And most of our people really focus on that incremental improvement, the same as I do, at my level. Everyone really focuses on making the next deal better than the last, right? So, getting a loan done, figuring out, what went well, what didn't go well, what can you do better next time, right? And building upon, upon that past progress. And that's something that over time, I think has really made us a very stellar group of individuals. We also are big proponents of technology. All right. And so, some of it works extremely well. Others, we need to massage a little bit. But we like being early adopters. We like, not bleeding edge, but, maybe fast follower on a lot of, a lot of the exciting changes in the industry. So we're generally pretty open to, change as it comes, which there's no shortage of these days, as well as some of the cool technologies that we're seeing. So I
Yeah.
really appreciate that about our ops structure.
Yeah. And what are the projects that you're working on, and some of the initiatives that you're trying to carry forward to create that efficiency?
I could spend all day talking about that, but probably my favorite one that I'm working on currently is what I call our source data strategy. And so that's where we're working with Argyle to automatically have every customer at least presented with the opportunity to integrate their payroll and integrate their bank statement accounts, with that third party service. So that way we can get those service tokens and feed them into our AUS to unlock additional opportunities, inside of the loan file, such as getting rep and warrant relief on certain attributes, or even being able to boost a borrower's chance at qualifying or getting that approved eligible from, Fannie Mae or Freddie Mac. To me, that's one of the coolest things in the industry, and we're really pushing forward on that to try to take full advantage.
Yeah, we were talking about this in the prep too, because I think it's important that so many times that we're so focused on gaining efficiency that we forget the borrower experience side of things. And are we providing the best service to our clients if we're only running DU and taking what DU gives us? No, we're not. We need to be running dual AUS and making decisions around which direction that we go based on what is most beneficial to the borrower from a condition perspective, from a rep and warrant perspective for on the lender side. So it's not, and it is, it seems as though the character of loans gets even hairier, more hairy every day, that there are changes and adjustments to what is allowed differently from each of the agencies. So I want to dive into eNotes because eNotes just crossed 3.2 million registrations on the MERS e-registration, and MISMO updated its smart doc standard. So digital closings are becoming a default. I know that this has also been a focus for First Option, but where do you stand on eNotes and the digital closing adoption?
So this is one of the things that I am, really most proud of. I pulled the reports the other day, and even I was blown away by our progress on this. I I'm amazed at how quickly we've been able to roll it out and the kind of efficiencies that we're getting. And so, some listeners may recall seeing me in some of the working groups asking questions about the about eNotes in 2025. It's because 2026, this is one of the biggest things on our agenda, and I feel like we've really hit it out of the park. And I'm really committed to helping other lenders do the same thing. So in December, we got our MERS e-registry approval. And at that time, we made a decision as of January 1st of this year, we were going to move from an opt-in to hybrid closing to an opt-out, meaning instead of having a loan officer or branch choose loan by loan that I want this closing to be hybrid, with the default being wet, we flipped that on its head, right? So our new default closing method is hybrid, right? So unless you tell me that your customer wants paper, it's going to be a hybrid, right? And so we did that for all loans starting January 1st. So our hybrid adoption rate shot up from about 35 to 40%, all the way up to about 80 to 90% now, right? Just by changing, the default
Yeah.
behavior, right?
Yeah.
And so in the first quarter, we've worked to get warehouse approvals, investor approvals. That actually took quite a long time, right? I was actually amazed at how much legwork it took to get everyone to sign all the right agreements and do all the requisite testing. By about halfway into April, we were ready to actually start closing our first eNotes in production outside of the approval process. And so now we built from that base of having 80 to 90% of our closings be hybrid. Then we purposely started cannibalizing that hybrid volume to then make it hybrid with eNote. So the key thing that we did in our LOS, and again, the administration hat really helped with that because I knew what was possible and could go ahead and do it. We have the LOS enabled with logic to determine on a loan by loan basis, are there any reasons why this hybrid closing can't also be eNote, right? And so if it meets the criteria, it's automatically opted in, right? And so we are now at a point where, of our total volume, company wide, only 10% of our loans are closing, exclusively on paper. A full 50% of our loans are closing as hybrid with eNote, right? And then the other 40% is closing classic hybrid with a paper note. Most of that paper note, the 40% is because we haven't yet rolled out eNote on FHA, which is one of our opportunities and challenges there. But almost all of our conventional business is closing on an eNote. All of our VA, all of our USDA, all of that's closing on an eNote. And the big holdout is, like I said, FHA, simply because our top investor doesn't yet accept eNote on government. And then also our non-QM slice of the business. I only have one non-QM player accepting eNote, but we are pushing it to the max in every way we can because the efficiencies are just so insane. On our conventional loans, it was taking an average of 16 days from funding to purchase. And now with eNote, it's down to about 8, literally cut in half. And I'm seeing the results. I'm almost kicking myself for not doing this last year or the year before. But hey, better late than never. But the
You're,
opt-in was key, and then the default is key for us as well.
yeah. You're not getting that call from the CFO that you have to slow down the purchase off of the warehouse line for the fee
I
income.
I would love to have that call. I'd love to hear that, because that tells me
Yeah.
we're doing a really good job.
Yeah.
Um,
No, definitely, faster clears, lower cost, better borrower experience. And, we
mhm.
talk about adoption in the industry. So I think it's like great points of how to move forward on that. Um, what do you think was the biggest internal hurdle that you faced? Was it tech, training, investor acceptance? What was your biggest hurdle?
So we have a couple categories here. I mean, I think one of the biggest ones was, just first off, getting enough of our counterparties onto the e-registry. So we needed all of our warehouses to be on there. We got that pretty early. The biggest hurdle was the investors. So if we're hedging a lot of our volume, right? And so if our top bidders are not accepting eNote, you kind of have to make a decision. Do you cut off your top bidders because you want to close on eNote, or do you hold off on the eNote, to maximize your execution? There's a real trade-off there. So what we saw was, on the conventional side, every all of the major investors were accepting E-note. So we went ahead and did it. Same thing on VA, same thing on USDA, FHA's that holdout. The other big thing that we saw many, many years ago was, title company pushback. There wasn't a great understanding from the title side of, what the hybrid is, where do they look? Why does the package seem like it's only half there? We've largely overcome a lot of that as these companies and vendors have gotten more experience with it. But the other big category, was what I call, vicarious pushback, right? So when you introduce something different, everyone comes up with some reason why it won't work, right? So, my borrowers are never going to do this. My borrowers won't like this, but at the end of the day, no one actually asked the borrowers, right? And so when we change that opt out, when we change that
Yeah.
opt in to an opt out, turns out the borrowers loved it, right? I mean, the
Yeah.
same borrowers who are already signing disclosures electronically in the beginning, they have no problem signing disclosures electronically at closing, right?
Yeah.
It turns out the language barriers, the age, the culture, none of that really held water, because we're closing the vast majority of our loans electronically. I mean,
Yeah.
it's kind of eye-opening.
Yeah, I definitely, early on when point of sales became a thing, the pushback was like, our borrowers will never do this. And then I worked for a lender that had almost 50% Hispanic borrowers, and like,
Mhm.
there's a language barrier, it's never going to work. And what we found is the Hispanic borrowers actually completed the point of sale application digitally at a higher rate because oftentimes they had one of their children or a relative that was helping them through the process. So that was before you could get the point of sale in Spanish language. So it was
Yeah.
what we found out then, I'm sure carries over into the e-note. And it's like you're selling against the loan officer because the loan officer is not even attempting to try it, or worse yet, they're talking the borrower out of it and giving them doubt and
Yeah.
hesitation. So I like the play that you did on that to make it work for your organization.
Yeah, I think the loan officers are just afraid of having to play tech support on one more
Yeah,
system.
yeah,
But it's important to choose a good partner, right? And so we've used SnapDocs. I mean, their login, if you can get a text message, you can log in. There's no
yeah,
password. I mean, it's very, very easy. So the LOs are kind of relieved of that burden. Once they
yeah,
witness that, none of them really
yeah,
push to go back, right?
yeah,
It's just that initial fear. So,
yeah,
but we're not yet doing Ron. So Ron is a whole
yeah,
nother animal. I think, we'll kind of ease our way into that. But we went hybrid to eNote, and then we get a critical mass on eNote. Then we'll introduce Ron. But there's additional
yeah,
challenges on that where you go county by county. Investor acceptance is a whole nother thing. Plus the
yeah,
cost is much, much higher. So we're going to have to come up with a strategy on that. But I think it'll
yeah,
be inspired by what we've done
yeah,
with the hybrid and
yeah.
eNote.
Absolutely. All right, we're going to talk about the dreaded four-letter, five-letter word rate or rates hitting 2026 highs in the headlines. And from an operation seat, what does a stuck rate environment actually do to your pipeline and your staffing?
Well, it's not great, right? So pipeline and staffing both like lower rates. So volumes down, obviously compared to years when we've had lower rates. But fortunately, we've run lean for a long time. It's just part of how we do business. And I think about all these stories where someone's business hits the rocks and they swear to get back to basics, right? So you hear that a lot. And then you never really hear like who told you to get off of the basics in the first place. Like that kind of goes by the wayside. So we really try to remember like, if you add more people than you need now, I mean, you may have to peel them back later. If you add more cost than you need now, you may have to peel it back later. And no one
Yeah,
likes those peeling back conversations. So we really, really try to keep our staffing lean, keep the costs lean. And, it's helped for a long, long time to remain profitable. And so we have a little bit better ability to weather these kinds of environments than maybe the average. But if it goes on for too long, we're the same as any lender. You start looking at what you can cut back on.
Yeah.
Fortunately, we haven't had to do much of that in the recent past. But, when we do, it's always the discretionary stuff. Are there technologies that are not being used? Are there, contracts we can cancel? Are there spaces we're renting that we can get rid of, right? If there's no
Yeah.
foot traffic, if folks are working from home and not going in, can we not renew the lease? And we've done a fantastic job at making those kinds of decisions as you go, so that we don't come to a crisis where we need to make a bunch of decisions now. But there's a silver lining in the higher rate environment, and that's where we're seeing a lot more business on the non-QM side. So the non-QM customer profile is a lot less rate sensitive, than like a first-time home buyer looking for an FHA or a home ready loan. So we have
Yeah.
seen that kind of pivot. It's not a one for one. We haven't magically found enough non-QM buyers to replace everyone that's, put off purchasing on the agency side. But, with fiscal prudence and with the non-QM opportunity, we're doing pretty good in this environment.
Yeah. Yeah, I was doing research for the upcoming tech summit, and because we have a couple of the presenters are in the non-QM space, and it's estimated that 15% of originations in 2026 will be of the non-QM variety. So an area where all lenders need to be prepared to operationalize and also to equip their loan officers with the training and education to be able to understand. And I think that's another silver lining here for ops teams. I think you're using it this way, but is it more time to invest in process and tech instead of just keeping up with volume?
Yeah, I think there's definitely more time to, work on various projects. And, to some extent, the one of the reasons we're able to pull off the eNote transition was because we did have a little bit more breathing room. It would be more
Yeah,
difficult to roll out a big change like that, when everyone is slammed with volume. So, I mean, I think
for sure.
you can time things in the year. We like big changes in January, right? Just to,
Yeah,
to kind of kickstart because a lot of our markets, they have snow. People aren't trudging the open houses, so we've got time. Um, but the other thing, it's not really a financial benefit or anything like that, but we've seen that it's a little bit easier for folks to take some time off and enjoy time with their
yeah,
families a little bit this summer. And there's some seasons of life where you kind of need that, right?
yeah,
Obviously,
yeah,
with a new baby, I'm in that boat too, right?
yeah,
But
yeah,
I'm not the only one. So
yeah,
some years you can do that a little bit more than others. So you just kind of
yeah.
appreciate what you can.
Yeah, so all of the CEOs of mortgage companies whose employees are scheduling time off right now, you can point back to Kevin's suggestion of using the time to recharge. No, it absolutely is important. And we were talking about just the programming for the Mortgage Collaborative, and the first 2 weeks of July, it seemed like everybody was off, and even a company that you mentioned gives their entire company off. It's just everybody has to be available for an emergency, but they're off the week of the 4th. So it is important to take that time. So
Mhm.
there is also some good news coming out of the market. We're hearing that 2026 might be the first year since the pandemic where incomes are actually outgrowing home prices. That would be very positive. Are you seeing that show up in your loan files and borrower profiles today?
I don't know that we see it show up, but I sure hope it's there, right? So I
Yeah,
think the statistics can be a little tough. Number
yeah,
one, we are a small lender, right? In the grand scheme of things, we may not reflect a national trend as of yet. But, the other thing you got to keep in mind too is, we see qualifying income. We don't necessarily see the gross income in an organized way that would be reflected in national wage data. So if you get a raise last week, you're not necessarily using it to qualify for a mortgage this week across all programs. Or, if you're self-employed, maybe it needs to bake into, your next tax return or something like that. But I sure hope that that's there in the data. Um,
yeah. Yeah, and I think, with rising inventory plus a little more affordability, I think that we in as the mortgage industry, we have long-term memory loss. We only survive on short-term memory, and we're extremely optimistic. So, any blurps of, and if we hear any speaking of rising inventory and better affordability, then we're optimistic that that will fill up pipelines, even if we stay in a stuck rate environment, we'll call it, but it's amazing. I think that we got used to those higher interest rates doubling. We got used to that, and I think that we know better how to sell and deal with it as industry. Do you think the affordability shift is big enough yet to offset the drag of that stuck rates, or do you think it's still too early to tell?
I think that the trend needs a little bit more time to bake. What I put more stock in is the inventory side of that. So if you happen to be in a market that has increased inventory and homes are taking longer to sell, right? So I mean, us in the lending world, we can work with our real estate agent partners to do things like maximize the seller credit, right? So a seller that wants to move that house, right, and is struggling to do that, they may be more willing to grant a larger seller credit. You can use that seller credit, right, to help defray some of the closing costs on a loan, right? And that's one of the biggest impediments to buying is just having enough cash to do so. You can also convert that into, discount points to help lower that rate and ease that payment, as well as a temporary buy down. So, I mean, seller credits is one of the hidden gems in this in the lending business. I think you can leverage that to really, really great effect if you know how to negotiate for it and then how best to optimize, how it applies to your specific loan. But that's enabled by the inventory side of that. So I'm a
Yep.
big fan of doing that.
Yeah. Awesome. And then no shortage of consolidation continuing in the industry. And if you get Swerve's blurb or look at Rich Swerbinsky's post, you already know that Cross Country was approved to acquire two harbors. And we believe that that consolidation is going to continue throughout 2026, even to the point of making it one of the key focuses of when the middle is vanishing, what can you do as a lender to protect yourself as a focus in the upcoming Austin conference. But I want to shift quickly before we end to the CFPB. And July 6th regulatory agenda is loaded with mortgage items tied to promoting access to mortgage credit, executive order, the RFI targets TRID, right of rescission, and reverse mortgage disclosures that stated direction in streamlining, not new burden. And I know that our advocacy committee was working yesterday on a response to the CFPB and some of their open where they opened up for comment. But the read on the new CFPB agenda is that it's aimed at reducing costs, not adding rules. Does that match what you're seeing, or is your compliance team bracing for more work either way?
I think we are going to see a reduction in the rules. I hope that this is done, while still keeping the consumer protection mission in mind. There are some rules that, I think you could do away with and everyone would benefit, including consumers. And there's others that, I think are there for a reason, right? So I just hope those, the guiding hand can tell the difference between the two and, cut tactfully.
Yeah. And on the CFPB strictly, some are arguing that the enforcement, it just changes where the enforcement is coming from. So it's like, don't let your guard down because you are going to be enforced one way or the other. But on the TRID topic and rescission changes that have been being floated around, do you think that the CFPB actually simplifies those? And what would that mean for your closing team specifically if that you were to see changes in TRID?
Yeah, so I think there's a number of things that they could do to actually simplify that. One of the biggest ones that would affect the consumer specifically is getting rid of some of the triggers that would reset the 3-day closing clock. Right. So we see a lot at the last, say the day before closing, a customer all of a sudden wants to change their balance between, the interest rate and discount points or interest rate and lender credit. So if you do that the wrong way, you've just moved your APR and now you have to wait another 3 days to close, even though the customer is the one that asked for that. It really doesn't
Yeah.
make sense. But the way the rules are written now, like you don't really have a choice, and you can't really waive it unless you want to own that loan. So
Yep.
things like that, I think they could change relatively easily, and it would benefit everybody. And then like what counts as a tolerance cure? Where do you need to be on the benchmark for APOR? I think there's a lot of room for improvement on these that would benefit not only the industry but the consumer as well.
Yep. And we will be releasing a letter to the CFPB. We'll make sure the network has access to that when we send it out. But for today, that's a wrap. So, Kevin, thank you so much for joining us and talking about what has been going on with the industry from the practical standpoint. And thank you for the listeners for participating and taking time out of your Friday afternoon or morning, depending on what area of the country that you are in. We really appreciate all of you, and we'll see you in a couple of weeks on the latest in mortgage today. Thanks again, Kevin. Have a great
All right.
weekend.
Thank you.